Chapter 2, Question 24. Following our pre-acquisition financial balance for Pedro Company and Seoul Company as of December 31st, also include our fair value for Seoul Company's account. On December 31st, Pedro acquired Seoul's outstanding stock by paying $360,000 in cash and issuing 10,000 shares of its own common stocks with the fair value of $40 per share. Pedro paid legal and accounting fee of $20,000 as well as $5,000 in account issuance cost. Determine the value that would be shown in Pedro's consolidated financial statement for each of the accounts listed. Alright, so the question asking for the consolidated balance of those accounts. And the basic equation or formula we use in those acquisition questions is to use parent company's book value on the acquisition day and plus the subsidiary company's account fair value on that date. So this is called acquisition date fair value method. And we do not use the subsidiary company's book value. So this is not the value we use. Instead, we're using the fair value of the subsidiary company's accounts, identifiable accounts. Okay, so before we calculate the consolidated balance of those accounts, first let's look at what happened on that date and let's prepare some journal entries or do some calculations. First, on December 31st, Pedro acquired Seoul's outstanding stock, which means that Pedro is the parent and Seoul is the subsidiary company. Okay, so in order to for the parent to acquire subsidiary outstanding stock, they paid $360,000 in cash, so this is part of the payment, and also they issued 10,000 share of its own stock with fair value of $40 per share. So in total, that's a total consideration transferred from the parent company to the subsidiary company. So first we can calculate what is the total consideration paid. That is $760,000. And then what we can do following the consideration paid is how much the parent gets in this acquisition. In other words, what is the fair value of the subsidiary's identifiable assets and liabilities? So identifiable assets and liabilities are those assets and liabilities on the book. Okay, so those are the identifiable assets and liabilities. The question is, what is the net amount of fair value of them? Then it equals to the total assets. Okay, so it's going to equals to the fair value of the identifiable assets, the total amount, and then minus the fair value of the total identifiable liabilities. So this is the asset and minus the liabilities. Then we can get $680,000 is the fair value of the subsidiary identifiable assets and liabilities. So basically what we did is we used the total fair value of their assets and minus the fair value of their liabilities. In other words, the parent company is able to obtain all the assets, but at the same time they have to consume all the liabilities. And in this transaction, it will say that the total consideration paid is larger than the fair value they acquired, and then that's goodwill. So which means that this goodwill is like zero. The amount they overpaid, $80,000, is the amount of the goodwill. And there are a few other things we can calculate as well. First, let's prepare the journal entries related to the issuance of its own common stock. So when the company issues stock, the typical journal entry is debit the cash, credit the common stock, and additional paid in capital, assuming they have a par value for their stock. So in this transaction, the total cash they acquired is 10,000 shares times $40 per share. That's 400,000. And the amount to their common stock is the total amount of 10,000 shares and times $20 par value of share. So the common we credit 200,000 to the common stock, and then the additional amount is for additional paid-in capital. Okay, so which means that additional paid-in capital is actually a plug-in number equals to 200,000. Next is related to some expense or cost they incurred in this transaction. The first one is this legal and accounting fee of 20,000. So that's additional expense. And for the journal entry for this one is to debit professional service expense and credit cash 20,000. And the other cost is this stock issuance cost. So for the stock issuance cost, we do not consider this expense. Instead, we deduct this 5,000 from their additional paid-in capital. So the journal entry is to debit additional paid-in capital 5,000 and credit the cash 5,000. Alright, so I'm going to use next video to calculate the consolidated totals of those accounts required in this question. Now let's calculate the consolidated balance of those accounts. In total, we have 5 accounts that we need to calculate their consolidated balance. Okay, so I highlight them here in this table. So the first one is inventory. So the consolidated balance of inventory is going to equals to Pedro's book value of inventory and plus sole company's fair value of their inventory. It equals to 670,000. As to land, we use parent company's book value and plus subsidiary company's fair value of their land. Then it equals to 710,000. Building and equipment, still book value on the parent's book and fair value on the subsidiary book, equal to 930,000. Next one, franchise agreement is going to equal to 220,000 plus 220,000 equal to 440,000. Next one is going to be the additional paid-in capital. For those equity account, since subsidiary companies owner already sold their company, which means that the subsidiary company's shareholder no longer hold any interest in this consolidated company, which means that all the accounts down here are going to be ignored. Okay, so the consolidated balance for the additional paid-in capital, it should equal to this 70,000. And plus, remember that when the parent company acquired the subsidiary company, they issued additional amount of common stocks, so that's going to increase their additional paid-in capital by this 200,000. And but that issuance cost is going to reduce the additional paid-in capital by 5,000. Okay, so for additional paid-in capital should equal to 70,000 and plus 200,000. This is due to the issuance of additional stock and minus 5,000 of the stock issuance cost, and the annual balance should equal to 265,000. Alright, so return earnings. The beginning return earnings is 390,000. It's not going to change. And then as to the annual balance of the return earnings, okay, I forgot one more thing. Okay, let's forgot the revenues. Revenues. So the revenues is going to be 960,000. As to those income statement accounts, we also ignore the subsidiary company's account balance. The reason is that those are not the revenue and expense incurred by the combined entity. In other words, those revenues are earned before the consolidation, and also those expenses are incurred before the consolidation. So we only combine the revenue and expense after consolidation date, but before that date, all those revenue and expense are not belongs to the consolidated entity. Okay, so the total revenue is 960,000. As to the expense, it's going to equal to 920,000 and plus this 2,000 professional service fee. So the total would be plus 20,000 equals 940,000. Okay, so the reason I just show you the revenue expense is because when we calculate the ending balance of retained earnings, it's going to need us to get the net income. So the ending balance of retained earnings should equal to its beginning balance of retained earnings and plus net income minus dividend. So in this question, we don't have any dividend, and but we need to calculate what is net income. So net income equal to the revenue, the parent company revenue, and minus the parent company's cost. So the total cost is 940. All right, so the annual balance of retained earnings is 410,000. So that's 410,000 for annual balance of retained earnings. One more thing is this goodwill. So I calculated goodwill in prior video. So goodwill is 80,000. So that's calculated already. All right, so that's will be the solution for this question. That's all the balance we just calculated here.